Hello, and welcome to this tutorial where we are going to study about accounting fraud related to capitalizing cost. Now, if we look at the P&L statement profit and loss statement of your company, then there is one kind of cost which is known as depreciation or amortization cost. Now, depreciation cost is in the case of tangible assets like plant property and equipment, and amortization is done in case of intangible assets like copyrights, patents, etc. So these assets like plant property and equipment, which are in the form of tangible assets, and these intangible assets like copyright and patents are expected to provide economic benefit over a long period of time. So let's say if I set up a factory, then the cost of factory should be spread in my P&L over a long period of time, maybe 20 years. Benefit of setting up a factory is going to happen over the next 20 years of 25 years till the lifespan of this factory. So rather than incurring the cost of factory in a single year, what we do is that we divide the entire cost of factory divided by 20 years or 25 years, assuming the straight line depreciation. And in each year we allocate certain portion of the cost, and this portion is known as depreciation. So let's say if the factory cost is $200,000, so rather than taking a hit of $200,000 in the P&L in year 1, I'm assuming that the factory got constructed in year 1. We spread this $200,000 cost over the next 20 years. And assuming the straight line depreciation, it amounts to $200,000 divided by 20, which is equal to $10,000. So $10,000 per annum gets deducted for the next 20 years as my depreciation expense. It is the concept of matching revenues with expenses, or the cost for those equipment whose benefit is going to happen over the next many years rather than in one particular year. So those costs are depreciated rather than incurring them in 1 year. So this is where the concept of depreciation in case of tangible assets and amortization in case of intangible assets comes into picture. Now, there are certain accounting rules that a particular cost can be capitalized and some cost cannot be capitalized, like the wages paid to the workers. My SG&A expenses, these cannot be capitalized. These have to be incurred in the year in which these costs are made, or the company spends the cash over this to cover this cost. So manipulation of depreciation provision is what is meant by accounting fraud related to capitalizing cost. So rather than deducting certain costs from profit, companies put those in the balance sheet as an asset. Let's say if company spends $10,000 in the form of wages paid to the workers and SG&A expenses, then the accounting treatment requires those $10,000 to be incurred in year 1 itself, the year in which these costs were covered, rather than capitalizing them, because these costs are not to be capitalized as per the accounting rules. Now, what some companies have done is that they have put this cost as a long-term asset in the balance sheet and they depreciate it over a period of years. So let's say my SG&A expenses continue with the same example. SG&A expenses is $10,000. So my SG&A line in the P&L statement should show a deduction of $10,000. Now, what some companies have done, which is fraudulent in nature, is that they have put this cost as an asset in the balance sheet, the same way as we do for plant property and equipment. So they put this cost as an asset in the balance sheet and then deduct some part of it as depreciation expense. So let's say if this SG&A expense is getting depreciated over next 10 years, then this 10,000 divided by 10 is equal to $1,000 is actually hitting the P&L statement. But actually it should hit $10,000 in the first year itself, rather than spreading $1,000 for the next 10 years, because SG&A expense is not a part of long-term asset, and hence it cannot be depreciated, and hence it should be expensed when incurred. Now, let's talk about WorldCom company. Rather than deducting certain costs from the profit, the WorldCom put those costs in the balance sheet as an asset. And this will inflate the earning because the cost of the long-term investment depreciation is subtracted from the earnings over a period of time rather than once upfront. So rather than deducting 10,000 only, 1,000 is getting deducted over the next 10 years. So in the first year, my income goes up by $9,000 just because of capitalizing the SG&A expenses. In fact, it is hard to detect this kind of fraud only by looking at the company's financial statement. One should look beyond the financial statement next to rivals and question the capitalized cost, which are out of line now. It is very hard. We have taken the example of SG&A expenses, but there are certain costs for which we have to look at the financial statements of next to the rivals and do the benchmarking, and then find out if those costs can be depreciated of it should be expensed when incurred. So now we're going to look at the exact details of the case, which happened in case of the WorldCom. Now, the WorldCom said that it is improperly handled $3.9 billion expenses, which inflicted the bottom line in improperly capitalized cost, meaning it attempted to spread it over many years rather than taking the hit at 1 year. And this is how the analysts suspect it was done. So in the first step, what WorldCom did was there were costs including wages and salaries to the workers for performing the maintenance on telecom systems. So let's say this cost was $100,000. So this cost should have been a part of the P&L right in year 1 itself. We are assuming that the fraud occurred in year 1, so this should have been a part of the P&L in year 1. But what WorldCom did was that these costs were not put on the income statement. Rather than these costs were treated as long-term costs, and hence they were capitalized. So what WorldCom did was that on the asset side, it created a long-term asset of $100,000. Like we do it for plant, property, and equipment. And then it deducted the depreciation for 1 year. Let's say, if this cost was depreciated for next 10 years, then the depreciation cost per year comes out to be $10,000. So the value of asset at the end of year 1, 90,000, and only amount is equal to 10,000 got hit in the P&L statement. So only $10,000 was recognized in the P&L statement, and hence the income in year 1 rose up by $90,000 because instead of $100,000, only $90,000 got deducted. Now these costs were instead put on the balance sheet, which we talked about, which is different than the income statement as an asset, and the company are only supposed to do so when they buy equipment that will be used over a long period. Now, this kind of treatment is usually in case of PPE, plant, property, and equipment, where the value of the equipment is to be used over a long period of time when we purchase a building worth $100,000, we put it under PPE, that is, gross PPE, and then we deduct the depreciation, accumulated depreciation, to arrive at the net PPE. But this kind of accounting treatment is only valid for assets that have a long life period. Not SG&A cost or the salaries to the workforce, which should be expensed as incurred. Now, the WorldCom didn't depreciate the cost that were moved to the balance sheet, meaning that they were subtracted from the net income over time. So obviously, instead of expensing this 100,000, what WorldCom did was that it expensed this $10,000 per year. So naturally, the net income went up by $90,000 in year one. And this affected the cash flow profit and margins and the net income in the first year. And since the net income increases, the cash flow from my operations also got increased. And hence, the share price of WorldCom also got increased. So we can see that by improperly classifying the cost as a long-term cost and capitalizing them, WorldCom increased its net income and hence its cash flow from operations and hence its share price. So it is a part of accounting fraud related to capitalization.